As the U.S. markets are closed for the weekend, we're looking at the final print for Datavault IA Inc., ticker DVLT, from Friday, October 24, 2025. The stock finished the session at $3.42. This was not a quiet close. It represented a staggering intraday gain of $1.17, or 52.00% in a single 8-hour period. The action did not stop at the bell. In after-hours trading, the stock pulled back, dropping 27 cents or 7.89% to land at $3.15. The immediate expectation when you see a 52% gain on a NASDAQ-listed company is that a world-changing event has occurred. The assumption is a buyout offer, a complete earnings blowout, or a new technology that renders all competition obsolete. The reality, however, is far more complex and, frankly, far more chaotic. The first clue is the 7.89% drop after hours. The second is the stock's 52-week low of just $0.25. This isn't a story of a stable blue chip having a good day. It's the story of a speculative, volatile nanocap stock that has just become a battlefield. The 52% move wasn't the start of the story. It may have been the climax of a war that's been building for weeks. Let's establish the common ground. Anyone watching DVLT on Friday saw a parabolic move. The volume was astronomical, clocking in at over 197 million shares. To put that in perspective, the company's entire public float is estimated to be around 133 million shares. This means the entire tradable supply of Datavault AI stock changed hands on average 1.5 times over. This is not fundamental long-term investing. This is a high-frequency, algorithm-driven retail frenzy inferno. The common belief is that this stock is just getting started, that this is the moment of discovery. The challenge to that belief is the data beneath the surface. The 197 million shares in volume and the 8% after-hours rejection strongly suggest a blow-off top. A classic technical pattern where the last of the buyers are pulled in at the peak, only to be met by a wall of selling from those who bought at $0.25 or $1.25, and perhaps most importantly, from short sellers who were forced to capitulate. The catalyst for this entire move wasn't a single press release on Friday. This has been building. On October 6th, the company released a massive update. First, it announced a $150 million strategic investment from Silex. Critically, this investment is held in Bitcoin, and the company noted it had already seen an unrealized gain of approximately $17 million from it. In the same update, it announced partnerships with IBM and Cove on near quantum computing, and the incorporation of 4 new independent data exchanges. These are the core of the bull thesis: platforms to tokenize real-world assets like unmined gold and copper, and intangible assets like name, image, and likeness, or NIL rights for athletes. Then on October 21st, another press release hit, a partnership with a Zurich-based firm, Max International AG, to launch a Swiss digital real-world asset exchange, aiming to bring Swiss regulatory precision to the tokenization market. The expectation is that these press releases filled with keywords like IBM, quantum, blockchain, and AI justify the new valuation. The reality is that the stock was $1.34 on October 3rd. The move has been happening for weeks, but Friday was the day the dam broke. This brings us to the short side of the ledger. This 52% move has all the hallmarks of a historic short squeeze. The expectation is shorts are burning. The reality is that the data supports this. According to official data from the end of September, DVLT short interest had exploded to nearly 45 million shares. That is a massive bet against the company. For those betting against DVLT, the thesis was simple. This is a nanocap company with ambitious, futuristic-sounding plans but very little current revenue. Q2 revenue was just $1.7 million. While that was a 467% year-over-year increase, it's a tiny figure for a company now sporting a market cap that, depending on the data source, is anywhere from $220 million to over $800 million. The shorts were betting that tokenizing gold and quantum computing were just hot air, designed to pump the stock. They were betting the company, which is not profitable and has a trailing 12-month earnings per share of negative $4.11, would run out of cash. They were wrong, or at least their timing was disastrous. The combination of the $150 million Silex investment, which shores up the balance sheet, the IBM news, and the Swiss exchange news created a perfect storm. As the price started to rise, short sellers were margin called and forced to buy back the shares they had borrowed. This forced buying or covering is what turns a 10% rally into a 52% explosion. The data from last week confirms this. The borrow fee rate, the interest rate short sellers must pay to borrow shares, had recently peaked at an insane 57.19%. Even on Friday, it was holding in the 14% range, an extremely high cost. More importantly, data from Interactive Brokers showed that by Friday afternoon, there were 0 shares available to short. The well was dry. Anyone who wanted to bet against the stock couldn't. This is a critical insight for investors. You can find this data on platforms like Fintel or Ortex. When you see borrow fees spike into the double or triple digits and shares available to borrow drop to 0, a squeeze is often imminent. Another massive red flag for the shorts was the fails to deliver or FTD data. At the end of September, DVLT had a day with over 12.7 million fails. This means 12.7 million shares that were sold were not delivered to their new owners on time, a signal that can sometimes point to settlement failures or naked short selling. This created a coiled spring that Friday's volume finally sprung. What's your take on the short situation? Was Friday's 52% move the main squeeze, or is there more to come? Comment below. Now we have to look at this through the lens of the retail investor. Over the weekend, social media platforms on Reddit and X.com are on fire with posts about DVLT. You will see 2 distinct narratives. The first is the long-term bull thesis. This is a first mover in RWA tokenization, it's a silent partner of IBM, it could be an acquisition target, and it's going to $10 or $20. The second narrative is that this is a classic pump driven by retail frenzy, and that anyone buying now is bag holding for the insiders. The reality is that both can be true. The company is working on legitimate, forward-looking technology. The CEO, Nathaniel Bradley, has been increasing his position, converting debt to equity at $0.32 back in September, a bullish sign. But the stock's price action is now completely detached from those fundamentals. It is trading on pure momentum, technicals, and the dynamics of a short squeeze. Chasing a 52% vertical move is the definition of high risk. The 8% after-hours drop is a clear warning that the sellers are already active. So who is Datavault AI? Putting the stock chart aside, the company is attempting to build the infrastructure for the Web 3.0 economy. Its core idea is to create digital twins of real-world assets and monetize them. This includes their international elements exchange for commodities, their NIL exchange for sports and entertainment, and their information data exchange for corporate data. They are, in essence, trying to become a stock market for everything. It's an incredibly ambitious vision. The problem, and the core of the bear thesis, is competition. They are not just competing with other startups, they are competing with giants like IBM, who they are also partnered with, Microsoft, and a dozen other deep-pocketed players who are also looking at the data monetization and tokenization space. The company is not profitable, and its long-term survival depends on its ability to execute this vision before its $150 million cash pile runs out. This brings us to the future outlook and what to watch next week. The bull case is simple. The short squeeze is not over. The shorts who covered on Friday may try to re-establish positions, but the high borrow fee and 0 share availability will make it difficult. The stock could consolidate around $3 and then use that as a new support level to attack the $3.59 high and move into blue sky territory, with some traders targeting $4.75 or $5. The bull case relies on new buyers and new momentum entering the stock, fueled by the weekend's social media buzz. The bear case is far more pragmatic. The 52% share volume was the blow-off top. The 8% after-hours drop is the first wave of profit-taking. This will continue on Monday morning as those who bought at $2.50 or $3 are happy to sell for a quick gain. The real danger, however, is dilution. On October 17th, Datavault AI filed a Form S-3 with the SEC. This is a shelf registration which essentially gives the company a blank check to sell new shares into the market at any time. After a 52% price spike, what is the most logical thing for an unprofitable company to do? Raise capital. They can now sell 10 million shares at $3 and instantly add $30 million to their treasury. This is smart for the company, but bad for the stock price as it floods the market with new supply. That 8% after-hours drop might be investors suddenly realizing that an offering is likely imminent. So, here is the expectation versus reality for the week ahead. The expectation from the retail crowd is that Friday's 52% move is the beginning of a run to $10. The reality is that the stock is now facing 2 massive headwinds: exhausted buyers from the blow-off top and the imminent threat of a share offering from the company itself. The battle will be fought around the $3 to $3.15 level. If it holds, the bulls have a chance.
If it breaks, the air pocket below is large and a fallback to the $2.50 breakout level is highly possible. Let's hear your thesis. Is Datavault AI with its IBM partnership and RWA exchanges a legitimate long-term hold, or was Friday's action a classic speculative bubble? Comment below with your thoughts. In summary, Datavault AI was the epicenter of the market on Friday. The narrative that it's a revolutionary AI and blockchain company ignited a fire. But the reality is that the fuel for that fire was a high short interest, massive FTDs, and a low float structure, all lit by a string of well-timed press releases. The 52% gain was the explosion. The 8% after-hours drop is the smoke. Now, as we head into next week, the question is whether any fuel is left or if the only thing that remains is gravity.